Meet Alex. Alex just got their first real paycheck, 25 years old, excited, a little nervous, and about to make almost every mistake most of us make with money. Not because Alex is bad with money, because nobody ever actually explained any of this. So today, we're going to follow 1 year of Alex's life, and by the end, you're going to understand the entire financial system: banks, credit, debt, taxes, investing, inflation, all of it. Not because I'm going to lecture you, because you're going to watch it happen to someone else first. It's Alex's first payday. The number hits the bank account, and for a second, Alex feels rich. Here's something Alex doesn't know yet: that bank isn't just holding the money safely, it's using it. Every dollar sitting in Alex's account, the bank is quietly lending out to someone else. For a car, a house, a business, and charging them interest. That's literally how banks make their money. A few weeks later, Alex buys a coffee, forgets to check the balance, and spends $1 more than what's actually there. The bank charges $35 for that mistake. $35 for $1. Sound familiar? Most of us have done exactly this. It's not stupidity. It's a system that quietly profits off small, honest mistakes. A month later, Alex gets a letter. You're pre-approved for a credit card. It feels like a reward. It's not. It's a number. That number is your credit score. 3 digits that quietly follow you everywhere. It decides what interest rate you get on a car, whether a landlord approves your apartment, sometimes even whether you get a job. Alex gets the card, uses it responsibly at first, pays on time. Then, 1 year later, Alex closes an old, unused card thinking it'll clean things up. Instead, Alex's score drops. Nobody warned Alex that closing old accounts can actually hurt you because it shortens your credit history. The system rewards you for sticking around, not for cleaning up. Then comes the moment almost all of us know. Alex's car breaks down. $1,200. No savings built up yet. The credit card covers it. Alex plans to pay it off quickly. Life happens instead. Alex starts paying just the minimum payment, the little number at the bottom of the bill that feels manageable. Here's the part nobody tells you: that minimum payment is designed to keep you in debt as long as possible. With high interest working against you, that $1,200 can take years to fully pay off, sometimes costing double the original amount just in interest. This is the moment where a little debt quietly becomes a lot of debt. Not because Alex did anything reckless, because nobody explained how the trap actually works. Spring comes. Alex gets a raise at work and immediately panics. Wait, if I earn more, won't I get pushed into a higher tax bracket and actually take home less money? This is one of the most common fears in America, and it's completely false. Only the portion of your income above a certain amount gets taxed at the higher rate, not your whole paycheck. A raise never makes your take-home pay go down. Ever. Alex breathes a sigh of relief. Most people never even ask this question out loud. They just quietly believe the myth for their entire life. By year 2, Alex has a little breathing room. A friend mentions investing. Alex sees a flashy stock everyone online is hyping, the kind promising fast, exciting gains. Puts in $200. 3 weeks later, it crashes. Frustrated, Alex almost gives up on investing completely. Instead, Alex tries something boring, putting a small amount every month into a simple index fund. No hype, no excitement, no one bragging about it at parties. 5 years later, that boring, forgettable account has quietly grown more than the exciting stock ever did. This is the part almost nobody believes until they see it for themselves. Boring, consistent, and patient wins. One ordinary Tuesday, Alex is at the grocery store, and the total feels higher than it used to. Same card, same items, more money. This is inflation. Prices slowly rising across the economy, which means the same dollar buys a little less every year. This is also why interest rates keep coming up in the news. When prices rise too fast, the Federal Reserve raises interest rates to slow down borrowing and spending. It's an invisible balancing act happening in the background of every paycheck, every grocery trip, every year of Alex's life and yours. So that's Alex's year. A bank fee here, a credit card mistake there, a little debt, a tax myth, a failed stock, a boring win, rising prices at checkout. None of this happened because Alex was bad with money. It happened because none of it was ever actually explained. Not in school, not at home, not anywhere. You've probably lived some version of Alex's year already, maybe more than one part of it. Now you understand exactly why it happened, and that alone puts you ahead of most people. If this made things click for you, follow Fintellect Studio. Every week I tell a story like this one, and the psychology and system hiding inside it.